Hi guys, welcome to our third episode on basically the impact of COVID on various sectors. Today we would be looking at the impact of COVID on market risk practices. As always, the process by which we operate is where our student researches the impact and we discuss the impact with an expert. Today we have an expert, Mr. Yash Ratanpal. Yash is a non-traditional actuary who has served leading banks, financial institutions, and corporates across America, the Middle East, and APAC. He's worked extensively in quantitative risk management, predictive modeling, asset liability management, derivative pricing, and financial technology. He has assisted large banks and financial organizations to develop and validate various predictive models for regulatory requirements and internal decision making. He has extensive experience in forward-looking regulations such as CCAR, DFAST, Basel norms, IFRS 9. He's currently associated with ACES, a technology-centric consulting and product development company in Mumbai, Delhi, and Singapore. In his previous role, he was a quantitative risk advisor at Deloitte India. He's an associate member of the Institute of Actuaries of India. He holds a bachelor's degree in financial market and is currently eligible to be SERA, which is Chartered Enterprise Risk Actuary. He's also a committee member of the wider fields group in the risk management for IFOA and the banking working group for the International Actuarial Association. Thanks, Harsh, for coming down and sharing your experience with us, and enlightening all the students.
Thanks, Akash. Thanks for having me. I think it's a pleasure to spend my Sunday afternoon with IAQS talking about risk management and the impact of COVID on risk management. So yeah, looking forward to the session.
So today we would be having a student, Aryan, who is right now in first year, who would be joining us for the question. So the impact that this pandemic has caused has resulted in great market risk and liquidity risk. As a risk management expert, do you think that the stress models that are mandated by the regulators globally are able to, let's say, assess the impact caused by this crisis?
So that's actually not a very easy answer. The reason being that across the globe, different geographies have different regulators, or rather their own central regulators per se. Which means that every geography follows their own standard practices or principles when it comes to something like stress testing or stress testing models per se. Now, while we have the Central Basel Committee for Banking Supervision, which is BCBS, which did release a very comprehensive set of stress testing principles in October 2018, it is still not mandatory for every particular country to adhere to that. What that means is that there will be discrepancies in the way one particular jurisdiction or one particular country adopts or tackles the concept of stress testing as compared to another country. Typically, the way one of the key trends that you would see across most of the stress testing practices across geographies is that there are primarily two types of approaches. The first approach is a supervisory approach, which has been mandated by the respective central regulator itself. And the second approach is more on the internal approaches, which are more advanced and idiosyncratic to the bank itself. So while the supervisor does come out with a supervisory approach, which is standardized and generic in nature for the entire banking industry, typically these approaches are chosen or adopted by lesser developed countries or by banks which are not big enough to invest in developing complex models, because the return on investment would not be justified for that amount of effort that they put in. So basically, for people who have chosen to go using the standardized approach, I think in general, standardized approaches are very, very conservative in nature, because the regulators always want to be very conservative. Having said that, I think there are various kinds of stress scenarios that these stress models incorporate. But I don't think that there is any particular standardized model which would have foreseen the impact of such a pandemic coming into your stress testing models. Primarily, when we talk about stress testing in the banking sector, the first risk that comes into your mind is liquidity risk, credit risk, market risk, operational risk, so on and so forth. And most of these come from our imagination of the 2008 financial crisis, because that's what we witnessed ourselves. So it's easy for us to imagine that that scenario will happen again. But it's very difficult for us to imagine about something and to incorporate about something in our models that has never happened before. Something like this pandemic, right? I mean, while people might argue that SARS or MERS did happen before, I don't think we've seen anything in our lifetime close to this particular scale of a pandemic, right? So I don't think any particular standardized approach out there would have been able to cope up with this particular stress situation for sure. Having said that, when a lot of the more developed countries and the more superior banks would have developed some of their own internal model approaches, wherein they try to incorporate more complex stress scenarios and more rigorous stress testing. The idea of any stress testing is not to predict exactly what will happen. I don't think anyone can do that. So they wouldn't have been able to predict exactly what would happen, but their stress testing would have been rigorous enough to back them up with good enough capital, which would really go a long way in helping their cause during these periods, right? So even though a bank would have not predicted that, okay, maybe you're going to get hit by a coronavirus, they would have predicted something like a hurricane or a storm, which they do tag under the catastrophe stress scenarios per se, right? And they would have set aside capital or risk to safeguard against these catastrophe events. So the impact of actually whether or not these stress models have been effective or have not been effective, I think it's too early to comment on that at the moment, because I don't think we have even seen 25% of the entire impact of COVID pan out. I think we have a long way ahead to go to see how exactly this impact is going to pan out across the finance and the banking sector.
All right. I'll hand it over to you, Aryan. You can discuss on the questions that are there.
Thank you, sir. Once again, thank you for having me, and I'm happy to be part of the conversation. So right now, the biggest concern that people have right now is that due to the lockdown, the asset lending portfolios of banks are going to be heavily impacted. So there have been talks of NPAs rising to as high as 25%. What is your assessment of the impact on the asset portfolios of banks, both globally and in India?
Okay. So I think NPA problems have been, I mean, associated with India for far too long since we can remember, right? I think whenever someone talks about the Indian banking sector, the first word that comes to people's minds is NPAs, right? From the perspective of COVID, and I keep this discussion limited to COVID because if we get into the entire concept of why NPAs have been so high historically in India, that's an entire different discussion altogether. But I think from the perspective of COVID, the government has allowed banks to basically breathe a sigh of relief. What the government has done is that before COVID happened, a particular loan, for people who are not familiar with the concept of what is actually an NPA, or the full form of NPA is a non-performing asset. So when a bank gives out a loan to a particular customer and the customer is not able to pay back that loan as per the agreed schedule or time, it's classified as a non-performing loan or a non-performing asset. The existing regulation before the COVID world was that if a particular customer is unable to pay back their cash flows that they had promised the bank that they would, more than 90 days from the time that the cash flow was due. So let's say the cash flow has been due for more than 90 days. The concept is called a 90-day days past due or a 90-day DPD. That particular loan would get classified as a non-performing asset, right? Now, what has happened after COVID is that RBI has come out with a set of several measures. One of them measures being that they've introduced the concept of a 3-month moratorium period for most of the loans. What that means is that in addition to the original loan that was given out, the entire asset classification process of a bank is going to be put on standstill for a period of 3 months. That means that if a particular loan was given out to a customer and the customer defaulted on 1st March, right? For the next 3 months, the bank has the liberty to know, even though the customer has defaulted, the bank has the liberty not to classify them as a non-performing asset. So the actual duration of classifying a loan as a non-performing asset has actually increased from 90 days to 180 days. That gives banks a lot of time and a lot of buffer in hand to basically classify loans as a non-performing asset. So loans that could have actually been turned into a non-performing asset will not turn into a non-performing asset right now, but they might turn into a non-performing asset 6 months down the line, right? Depending upon whether or not they're able to pay it back that then. Now, why is this beneficial for the banks? Why is it beneficial for the banks is because every time a bank classifies a particular loan as a non-performing asset, it needs to like hold provisions against that particular loan. So there's around a 15% provision that needs to be held against each of the loan that turn into a non-performing asset. So by deferring the classification of a loan into a non-performing asset, you're actually deferring the maintenance of provisions for these bad loans. What that means is that the banks don't really need to take a hit on their balance sheet right now, even if those loans turn into an NPA. They have some time and some amount of leeway and some amount of leniency till the period of the extended 180-day moratorium period. After which, of course, if the loans still are defaulted, then depending on the measures that RBI comes up with, then the banks will start taking the hit on the balance sheet. But for now, at least it is a sigh of relief for the banks. So we won't see any significant financial impact on the provisioning side because of the NPAs for the banks right now. Having said that, what we're looking at is a very, very tight rope, because if the situation continues for longer than expected, uh, you can keep delaying the moratorium period to 180 days or 365 days. At one point of time, the cycle will have to stop. And when it does, people who are still not in a position to pay back those loans are all going to default together in clusters. And that means that the banks would have to be ready with a lot of capital on their books by then to withstand that amount of pressure. And I think that is a good move by RBI, because RBI is basically telling the banks that just because we've delayed the moratorium period doesn't really mean that y'all can chill right now. I mean, it's not that you're not going to get affected by it. What RBI is trying to tell the banks is that this is the time where you'll need to start gearing up for what's going to come, because what's going to come is inevitable. It's just that you'll need to be better prepared for what's going to happen in the future. So yeah. So I think the NPA scene is definitely, the entire NPA portfolio levels are definitely going to rise up significantly in the medium to long term. But we have a short-term breath or a short-term gap, if I would say so, to just catch a breath of relief for now.
So basically, RBI has given time to prepare.
I would say, yeah.
Perfect.
So it's been a much needed sigh of relief for the banks.
Yes, for the banks, yes. But the step sisters of the bank, or what they call it as NBFCs, not so for them. Because while the banks don't really need to comply with the Ind AS regulation, which is IFRS 9 in the global terms, NBFCs need to. And as per the new IFRS 9 guidelines, the asset classification is way more stringent than it used to be before. What that means is that NBFCs can't wait for a particular loan to become a defaulter to classify them as a defaulter and start taking provisions on it. They need to be more proactive. So as soon as a particular loan starts showing signs of defaulting, the NBFCs start putting up provisions on those particular loans. So RBI hasn't really been very clear on the stance on how NBFCs need to deal with their NPAs. That is still, I think, a point which hasn't been clarified very clearly. I think in the coming days, we'll probably even see how that plays out. Hopefully, RBI will be able to sort that out as well. Yeah.
All right. So you already touched upon one of the things that the RBI has done. They've also taken several other measures to ease the problem of liquidity in the market in terms of liquidity facilities and LTROs. For those that don't know, can you first of all explain what an LTRO is and how it helps ease liquidity into the markets?
Sure. So before explaining the concept of LTRO, it's important to understand what is a repo. So repo is basically a repurchase agreement of a sort, right? So the way repo agreements work is that governments actually lend to the bank at a repo rate. It's like government is giving a loan to the bank in exchange for a collateral or a security, which can be, let's say, a government security or government bonds, which at the time of the expiry of the repo rate, there's an exchange of the collateral again that happens to close off that repo agreement, right? So it's a way for RBI to give money to banks directly, right? That is what repo is basically. Traditionally, we have two concepts in the Indian market. It's called the liquidity adjustment facility and the marginal standing facility. It's called the LAF and the MSF. The LAF and the MSF are actually tools for banks to borrow money from the RBI for short-term basis. So it covers your range, your overnight to the 1 to 28-day bucket for short-term borrowings, right, of liquidity. Now, the problem with LAF and MSF is that there are limits to how much LAF and MSF a particular bank can take from RBI. What that means is that from the overall portfolio of a bank, of the funds that they take from RBI. There's only a very small amount of proportion that they can take in form of LAF and MSF. What that means is that even if the RBI reduced the repo rate through LAF and MSF, the actual benefit of these repo rate reductions would not come down to the end customer. So what that means is that if the RBI gave the money to the bank at 5%, which it earlier used to give at 8%, the banks are of course getting that money at a more cheaper rate today. But me as an end customer, I might still be paying around the same amount of money to my bank for the loan. So I don't really get any benefit. The reason for that is because banks aren't being able to borrow a lot of money from RBI in terms of LAF and MSF. What that means that they're not being able to take a majority of the portfolio is not getting, they're not getting it at a subsidized rate, right? So they can't pass that benefit on to customers or end customer as a whole, right? So to solve this problem, what RBI did was something which has actually been taken from the book of what the European Central Bank did. So LTRO, or the full form of LTRO, is long-term repo operations. It was actually introduced by, it was done by the European Central Bank first. And RBI has taken a page from the book of the European Central Bank. The concept of LTRO, or the purpose of LTRO, is to inject long-term liquidity through banks, but directly into the hands of the end customer. So what that means is that when RBI announced that they're going to do a LTRO operation, they basically said that we are going to be giving banks, we are going to be giving money to banks in exchange for some collateral for the 1 to 3 year horizon periods, which is more on the medium to longer term horizon periods, right? So that the banks can take the money from us and directly give it to the end customer, and the loans given to the end customer are at a way lower rate than what they are today. What is the difference between the erstwhile or the still existing LAF and MSF and LTRO? Is that LTRO does not have any limits on it when banks are bidding for it. What that means is that now banks can take a very significant amount of money in their portfolio through LTRO, right? So most of the portfolio of the bank through LTRO is actually way higher in terms of the proportion and the amount when you compare it to the LAF or the MSF, right? So that means that the banks now are in a position to transfer that benefit to the end customer. So now finally, for someone like you and I who take final loans from banks, we are actually going to be witnessing the benefit of the reduction in the repo rate. Earlier, whenever RBI reduced repo rates, as an end consumer, we were never affected by it because we never really, it barely trickled down to us, the benefit. Now the benefit is going to be coming in a much more significant chunk, and every reduction in the repo rate through an LTRO operation would result in a very, very significant reduction in the loan interest rate that I'm paying as an end customer to the bank. So the entire purpose of LTRO operations is twofold. One, to give the money directly in terms of the end customer and not just chop it at the banks. And the second thing is to infuse long-term liquidity into the economy, because as we've seen in the 2007 to 2008 financial crisis as well, while there were big defaults, there were big credit defaults, there were crazy amount of market movements that were happening, but none of them actually shattered the market. What shattered the market was a liquidity crunch. Because when liquidity dries up in the market, that's when the economy completely comes to a standstill, and there is no possibility to either refinance loans or increase your supply to repay your existing loans or to come out of a vicious cycle that you got into, right? And hence our LTRO is one of the tools to increase liquidity and to ensure that the economy is shielded from a sort of a liquidity crunch.
So also, given the current condition and the unpredictability of the pandemic in terms of how long it's going to last, I think that's what makes the LTRO even more effective in terms of it's not a short-term solution.
Of course, because see, the idea is that you would want to increase the confidence of the end customers or the end buyers in your economy, because they are the ones who are going to increase the spending, and it's a way to boost their confidence in saying that the liquidity would be available for you at a cheaper rate. So, yeah.
Right. And I think coming out of this, when business and investor and consumer confidence will probably be at a significant low, I think measures like this are important to sort of bring back consumption and increase the consumption that has been impacted right now.
Definitely. Definitely.
So there's also been a huge discussion surrounding the negative crude oil prices, and people have highlighted the technical reason. But I was reading an article that said that the Indian exchanges don't have a software to handle the negative prices. What happened to the extreme event that happened to the crude oil prices in the Indian market, which the market wasn't able to handle. Do you think it's possible that that could happen to another asset class as well?
I mean, look, what happened was definitely something that no one saw coming. I think most of everyone was of the opinion that whatever we've studied so far in terms of economics or mathematics doesn't make sense anymore. But on the contrary, what happened actually reaffirms the belief in economics. Because what economics basically clearly tells you is only two concepts which primarily revolve around economics, is supply and demand. In the case of oil prices, what basically happened is that uh, while the oil production countries or the oil producers didn't really decrease the oil supply, they kept increasing it. There was actually an oil war that was happening between the OPEC countries and Russia as well, wherein they didn't really decrease the output, but the demand suddenly collapsed, right? So on one hand, you have the supply that's going up, and on the other hand, you have the demand that is coming down. So for the first time, or one of the few times ever, you've seen both of them happening together. Usually, you see a one-sided action that the demand falls back, but the supply remains the same, or the supply remains the same and the demand goes up, or vice versa, right? But I think this was the first time where we witnessed that the supply went up, but the demand fell down. And it took some time for the oil producers to realize that what we are actually doing is counterintuitive, and hence the price war did result in the end. But it was too late for that to happen, because of which what happened is that now you have a lot of oil at your hands, and oil being a commodity which isn't really very easy to store. It's not really like water that you can store it anywhere. It's not really like food grains that you can store it anywhere. There are very specialized warehouses and specialized storage facilities that need to be procured for oil storage, and they are expensive because any leakage of oil or mismanagement of oil can lead to tremendous amount of disasters. So in this scenario, what happens is that your particular storage cost becomes more expensive than the actual commodity itself. And what's actually happening is that the demand is absolutely not there. So the price has any which way has gone down itself. And on top of that, there is a crazy amount of storage cost that the particular producer needs to incur. So as a result of the same, the producer doesn't really have any amount of incentive to sell that to sell or distribute that particular oil barrel across the economy, right? And that's why you see this crazy amount of negative oil prices that actually happened in the US markets. Now, the reason I explained this entire concept of why oil became negative in the first place is because it's important to understand that any commodity which basically has a very high storage cost associated with it, and which is very complex to store, uh, there is a very strong possibility that if for any of those commodities, if we see a simultaneous increase in your supply and a decrease in demand, the prices of those commodities can go negative, right? In fact, I'll give you an example. In Western Europe, there are tremendous amounts of solar and wind energy farms that generate electricity for wholesale industries at a very large scale. During winters or during summers, or on Sundays particularly, these wholesale electricity rates actually go negative. The reason being that these particular farms keep on producing this particular output, but there is no demand for the same on Sundays, right? And for the same reason, any commodity out there can go negative, theoretically speaking, right? If the particular demand falls to such a low level and the supply increases to such a high level, and of course your storage cost just increases exponentially. So it's a combination of three things: your supply increasing at a very high level, your demand decreasing at a very high level, and your storage cost being at a very high level. I think that if for any commodity out there which has three of these factors, there's a very strong possibility of seeing this again. So, yeah.
And so, I mean, you would think that the chances of all three of those things happening at the same time are extremely unlikely. But I think given the circumstances, it's hard to say when or for which commodity exactly the all three factors will change. But I think it's it's definitely a possibility moving forward.
Yeah, sure. I mean, look, I mean, it's not like it's for the first time that we are talking about derivatives that have gone negative. I mean, there are various weather derivatives in the world that are always trading on negative temperatures in the world, right? So it's not something new. It's just that it's not normal. It's rather the new normal, as what they call it, and that's what has taken the market a little bit. That's what has surprised the market a little bit more than it should have. But I think from a pure theoretical perspective, it makes complete sense to everyone, I guess.
Now, you are an actuary and you have vast experience in the field. So, what role do you think that actuaries can play in risk mitigation when it comes to black swan events like the one we're currently experiencing?
So I think anyone who studied actuarial science or who's read about actuaries, or I mean, even going with beyond actuarial science, even statisticians, right? I think that is the end goal of the profession. Basically, understanding what are black swan events and how do you predict it better. And I think over the past few years, especially after the 2008 financial crisis, and now that I think about it, I think the 2008 financial crisis was maybe like for what was going to come in 2020, right? It basically significantly increased the focus and emphasis on risk management, and particularly on the area of tail risk. What tail risk refers to is that area of the curve or those particular scenarios or events that are very unlikely to occur, but if they do, they can wipe out companies or economies, right? And I think the erstwhile way of doing risk management was kind of a textbook exercise wherein you only ran your numbers or you only calculated numbers for those scenarios that were easy to imagine, right? Because people didn't want to be innovative with risk management. They were basically of the opinion that such events will never happen. What's the point of keeping so much capital aside for such events that are never going to happen, right? I think this particular pandemic proves the point and reaffirms the concept of tail risk and how important it is. I think tail risk is currently the most important aspect in modeling, whether it's for actuaries, for statisticians, or any other modelers or data scientists out there. The problem, however, is that with tail risk comes very few data points. We talk about having a lot of data, being data is the new oil, and using quotes which say that data is everywhere around us. But there is actually no data when there is barely few data points when you talk about tail risk. So I think the biggest challenge is to use and become innovative using our base mathematical principles to come around the concept of tail risk and understand how economies are correlated against each other when tail risk actually becomes active, right? And how can you safeguard yourself against this particular tail risk? Yeah.
All right. So you talked about how the 2007-2008 financial crisis was sort of uh, a precedent for the coronavirus pandemic right now. What are the risk management lessons that can be learned from the coronavirus, and what practices and protocols should be implemented going forward?
So I think it's too early to say that we are going to learn anything from coronavirus. As I said, I think we haven't seen even more than 25% of what has happened right now. Honestly, I don't think anyone knows what's going to happen. That's a very honest opinion. It's very it's a very complex matter. You have it. I think for the first time ever, we are seeing that it's not one particular industry or two particular industries that are facing the grunt. It's all the particular industries that are facing the grunt. Some industries are actually even making a lot of money during these times, such as your digital companies and your internet service companies. But then there are a few that are not doing so well. Um, I think what matters is that we need to get more innovative about how we are doing risk management. I think that's one of the biggest practices that we need to take, especially talking in the context of finance and banking. We only talk about events that are finance specific or banking sector specific, right? There's going to be a recession, there's going to be a liquidity crunch, so on and so forth. We never think about events that are outside our sector. For example, this pandemic was nowhere close to what or nowhere related to what the banking sector does, but it has completely impacted us and impacted the entire sector very, very adversely. So I think it's about being innovative. It's about thinking out of the box. It's we need to get out of the mindset that stress testing is just a textbook exercise. Don't just do it for the sake of doing it, because all the people who did stress testing in their true sense, I'm pretty sure they are bearing the benefits today. And the people who did not don't have the capital anywhere close to what is required to withstand what's going to come in the future. So I think it's about being innovative, getting out of the box, and getting outside the banking sector, and getting out of the mindset that things that are happening in other sectors don't affect the banking sector. Everything that happens outside the banking sector affects the banking sector, because the end customers to whom the banks are catering to are from these particular sectors, right? So I think that's one of the biggest takeaways I would feel so from a risk management and a stress testing perspective.
All right. Now, just to wrap up, for someone interested in pursuing a career in risk management, what does a job in this field look like, and what is the professional life like?
Very exciting. I think it's every day risk management has become very. I would say it's become one of the most popular career paths these days. People have started realizing how important risk management is. Everything around us is risk management today. Even if you're not in a risk management, you're not a risk management professional. Your day-to-day life requires a lot of risk management itself. Today, you go grocery shopping to your local market. I think it would be a good bet to work out the probabilities that what kind of people and how many maybe people are going to be there at what point of time during the day, so that the probability of you being safe is the highest, right? So risk management is around us in every way possible, more so now than ever before. I think the profession has evolved significantly from where it was, I would say, a decade ago. And even, I mean, forget a decade, even since when I started off my career, which was around 6, 7 years ago, I can see a huge difference in the way risk management is being approached by my own clients. It's not being seen as a tick box exercise anymore. People are actually using it to optimize their capital, which will inevitably lead to a more enhanced ROI or ROE for their equity stakeholders. So yeah.
I think moving forward, events like this can only highlight the importance of risk management. Like you said, people that tested their models are reaping the benefits, however marginal or uh, however marginal they may be. I think uh, events like this sort of bring careers and tools, risk management tools, to the forefront. Um, yeah.
So, yes, so considering that when you started off your actuarial career, you have taken a very non-traditional approach. Typically, actuaries, I still think that a lot of people think that it's still related to insurance. Uh, how has been your and what should be your advice to people who are, let's say, starting their journeys right now in the actuarial profession in terms of the non-traditional areas like the ones you are in?
So I think my advice would be, I mean, firstly, of course, would just want to like very categorically break the myth that there is nothing like actuaries can't work outside insurance. There are several actuaries working in areas outside insurance, me being one very small example. But in other than me, there are several more people who are doing wonderful work outside insurance. People are working in climate change. People are working in telecommunication companies. Actuaries are working in transportation companies like Uber, Amazon, Flipkart, helping with their data analytics and their machine learning work. So there's crazy amount of opportunity out there. My only advice to I think all actuarial professionals would be that, I mean, of course, it's very very prestigious to have the actuarial tag or the actuarial um, tagging to on your CV, and it's very good to be a part of the actuarial profession. Having said that, we need to respect that there are other professions out there in the world as well that bring in or have different capabilities or skill sets as well. I think there are a few areas that we as actuaries need to become a little bit more proactive on, because when we go out and work in these non-traditional areas, we are going to be competing directly against these other professions who are maybe better at a few things than we are not at. While we may be great at doing a lot of modeling and a lot of functional analysis, I don't think we are that good at technology. And I think that's one area where I would say we need to really, really pick our game up, because technology is going to be embedded in everything that we do in the future. Learn to code, whether it's something as simple as R, Python, or something more complex as C++. Do it. It's fun. And secondly, you will reap its benefits in the longer term. I think one of the important thing that I would say to all aspiring non-traditional actuaries is that whenever you're going out there, don't be afraid. You might think that there's no one around like you and you're alone in your particular journey. uh, Maybe, but it always so happens that when you're doing something which is different from what most of the people are doing, you will find it to be more uh, rewarding in the longer term than the others do. And for those reasons, I would say that whenever you're going out, like, network with a lot of people, go for conferences, go for seminars, speak to people, understand what all areas can actuaries work in other than insurance. And whenever you're approaching someone to work in such areas, don't go on with the fact and say that I'm an actuary, please hire me. Right? It doesn't work that way. I think what needs to be said, or the messaging that needs to be probably said, is that these are the skills that I have, and this is how I can help you. Right? So rather than saying that I'm an actuary and that is my professional tag and hence you should hire me, I think the idea should be that, okay, I know Python, I know R, I know statistics, I know mathematics. These are generic terms that are actual skills, right? And while a profession brings all of them together, people in a non-traditional industry might not understand what an actuary means. And hence we need to explain them through what skills we have first. And once they've understood what skills we had, then you can explain them later that, oh, by the way, I did actuarial science wherein I learned all these skills, right? So I think that's the process or the thought process that I would strongly recommend all people who are looking out to venture out into the non-traditional space. And yeah, I think don't be afraid to get out there. I think there is tremendous amount of opportunities, and you will be completely surprised to see the amount of application that your course material or study material has beyond insurance. So, yeah.
Great. So I think it was a great, insightful discussion that we had. Thank you, Yash, for providing such valuable insights, guiding the students. It was a pleasure to have you and discuss such great risk management practices. Hopefully, the coronavirus issue sorts out. I know you mentioned a couple of times we haven't seen the worst. Maybe, hopefully, we come out of it faster and we have start going on with normal life. Thanks a lot.
So I hope so too.
Thanks, Aryan.
It was a pleasure.
Thank you guys for taking the time out.
Thank you. Thank you. Bye.